What is EBITDA? What is EBITDA? Let me discuss this. This is very famous performance indicator, and there is a topic APM, alternative performance measures or additional performance measures in your course, and examiner asks things related to that also. Like 6 to 8 marks thing may come in your exam. 6 to 8 marks things you can expect 8, 9, something like that. Now, first of all, read this introduction. Go very slow and study with fresh mind. In our highly regulated world, financial statement of UK quoted companies must be drawn up and published in accordance with IFRS GAAP, right? Normally, in more than 100 countries, IFRS is applied. Thus, the format of the income statement is prescribed and standardized. And IFRS has set certain rules. We all know the rules. We all know the rules. We all know the presentation, the standard presentation. This is aimed at giving users confidence in the numbers that are reported. Yes, a regulated and standardized approach is designed to enhance comparability. Yes, they really want everybody to do almost same format, same type of accounting, so that the books are comparable. One of the objective of your framework of your standard board is to enhance comparability. We all know this. However, in addition, many companies also voluntarily produce alternative, see the word, performance measures, APMs. In other words, in addition to the various measures of performance outlined in the income statement, example operating profit and profit after tax, other measures are published. Now wait, the standard numbers, the standard names given by IFRS are not enough for this whole world, for all companies, because the nature of businesses are different, the nature of investors are different, the demand of investors are different. Investors want to see things in a different way, right? Each and everybody has a different taste, cultures are different. Now wait, so that's why the standard names, the standard presentation, the standard ratios given by IFRS are not enough to satisfy the whole accounting world, to satisfy the whole finance world. So what they do, they use their own performance indicators, extra performance indicators, right? So EBITDA is one of them. Earning before interest, tax, depreciation, amortization. Earning before interest, tax, depreciation, amortization. Okay, so this is not given by IFRS. This is the normal practice of people. This is the normal practice of people. Okay, now this is a tacit acknowledgement that the information required by the regulator do not wholly satisfactorily meet the information of needs of a company's user. I just told you this. I just told you this. Now, after all, it should be acknowledged that one size does not fit all. Okay, all see, IFRS standard numbers are not okay for everybody, right? APMs at their best seek to provide bespoke information about the companies. Bespoke software, have you ever heard? There are some ready-made software which you standardized software which you buy from the market, and sometimes you make your own software from software house. So these ratios, these APMs are your own performance indicators, right? According to the needs of your organization, you make your own performance indicators, you make your own ratios for your shareholders, for your users. Bespoke information about the company's performance that will help the user better understand the performance of the company and even predicts its future performance, okay. Now the name of this ratio is EBITDA, earning before interest, tax, depreciation and amortization. Sometimes people call it cash profit, some people call it cash profit, some people call it cash profit. Why? Because this depreciation and amortization is a non-cash items. This depreciation and amortization is a non-cash item. So when you remove these non-cash things, the profit is almost a cash profit. You can call it a cash profit. Now, a lot of arguments for this. This is probably the most famous all APMs. This is probably the most famous of all APMs. There are other APMs as well. Okay, many companies even publish their own EBITDA, even though it is not required. There is no requirement of IFRS. Yes, this is our homemade thing and not defined by any IFRS. So let us explore why it can be argued that EBITDA is a useful measure. Now, first of all, the name of this performance indicator, students, please don't sleep, please, just few minutes with me. Earning before, the first word is interest, before interest. Why this before interest? Because for companies, open your eyes, there are two major sources of finance. One is equity and the other one is debt. One is equity and the other one is debt. Now just think, there are two companies. One company is financed totally by equity, the other company is financed totally by debt. One company is financed totally by equity and the other company is financed totally by debt. So if you compare PBT of these two companies, so the company which is financed by equity, there is no finance cost, because ordinary dividends we deduct from SOCI, from statement of change in equity, not from income statement. But those companies who are financed by loan, they will have a high interest cost. So now this comparison is not like with like. Now the comparison between these two companies are not like with like. That's why we take before interest numbers. That's why in EBITDA we take before interest numbers. I hope you got it. Now, before tax, why? See, earning before interest and tax as well. Why before tax? Simple logic. There is a possibility that these two companies belongs to two different cities, two different countries, so there may be a different tax rate. At one position the tax rate is 10%, at the other end the tax rate is 30%. So again, this comparison is not like with like, because tax rate is not in the control of management. Tax rate is not in the control of management. Please have a look, read it. Now, next thing is the third was before interest, before tax, and now before depreciation and amortization. Now this is very interesting. Depreciation, first of all, depreciation is estimation. Depreciation and amortization is estimation, and when you include estimation in accounting, there is a chances of fraud. We can manipulate books when we are allowed to do estimation. So it's better remove the estimation thing. Yes. So first point. Second point, and this is also non-cash. So if we remove non-cash thing, we will come to cash profit. If we remove non-cash thing, we will come to cash profits. And a common man, not listen, all investors are not chartered accountants. Look at me, all investors are not chartered accountants. They don't understand accruals. Only me and you, we people understand accruals. A common man just understand the cash profits. So for the understandability of common man, EBITDA is a good thing, that it's a cash profit. It removes non-cash things. Now the third and the most super hit argument. See, now read between lines. Listen, there are two types of businesses. One business which is grown through takeover. One business is growing through takeovers. So those business which grow through takeover, they have a purchase goodwill, they pay goodwill, and that goodwill is recognized, and that impaired, then impaired, and we book impairment and amortization as an expense. The second type of business, are those business which grow organically, not through takeovers, just grow on their own. So those business who grow organically, they those business who grow organically, they don't book internally generated goodwill in their books, they don't recognize internally generated goodwill in their books. Just use your brain. So just if you compare these two, in the first company there is a goodwill, in the second company there is no goodwill. The company in which you have recognized the goodwill, you are also booking the amortization or impairment, but in the second company where there is no goodwill, so there will be no amortization or impairment. So these two books are not comparable, so better take a profit, which do not contain these amortization and depreciation, so that now the books will be comparable. Just use your brain. Now the books will be comparable. Use your brain. Read it. Please please read it. SBR, you should keep certain hours for reading daily. Reading, not writing, reading. Please read it, giving you time, especially giving you time. One more thing, when you do takeover, you book upward fair value adjustment. See, when you do takeover, you book upward, at the time of takeover, you revalue subsidiary companies, upward fair value adjustment. Because of upward fair value adjustment, in future you have to book extra depreciation. So now just think, those companies which are growing through takeovers, they will have more depreciation, and those companies which are not growing through takeover, they will have no extra depreciation. So again, these two books are not comparable. So it's better to take a profit before depreciation and amortization. I'm sure I'm giving you time to read. I'm giving you time to read. Now, one more thing. Listen, this is very good thing. Before exceptional items, it's better to exclude exceptional items. Exceptional items means one-off items. One-off items and one-off events distort comparability, ruins the comparability. For example, there is a fire occurs in our organization, so it's a one-off event. For example, we unintentionally we did a crime, we broke the law, and there is a huge penalty on us because of negligence. So this penalty is a one-off event. So it's better you exclude those one-off events, so that you can compare it with your past, and you can compare it with your competitors as well. Okay. And in this way, see, excluding these one-off items arguably enables users to understand the underlying performance. This makes APM predictive and therefore more relevant for users. One thing I would like to tell you extra. Last month, no, in the month of December, one of my friend came from Europe. He's working in Netherlands. So he told me that these APMs are in reality, these APMs are applied in those countries. But he said we do strict accounting for these APMs. So I said, why? So he said, because of these APMs, listen this, I'm telling you something extra. Because of these APMs, many analysts predict the future of company. Many analysts predicts the future profit of that company. And if you hide anything from the analyst, that means analyst figures will prove wrong in the end. So they blame you, they blame the management, that management is hiding certain things from us. Then that's not good for the goodwill of that company. You are not getting my point. Listen, not every part of the world these APMs are in fashion, but in Europe they apply it strictly. Because on the basis of these APMs, stock market analyst predicts the future of company, predict the future profit of that company by using different figures and in details working. So if these future profits goes wrong, then analysts blame the company's management, that company's management is not providing proper information to us. Did you understand these points? Please write on the chat box, I would be grateful. Please, if you understand the point, please write. APM full means additional performance measurement or alternative performance measurement. Quick, write, type. Now, one more practical issue. This may be tested. Now, see the next line. See this. Earning before interest, depreciation, and COVID-19. Earning before, see, nowadays this is also coming in fashion. EBIT DAC, not EBITDA, EBIT DAC. Earning before interest, tax, and depreciation, and COVID-19. COVID-19 was also a special event, one-off event. So because of COVID-19, you can't compare your last years with this year. You can't compare your last year with this year. So definitely there are companies, they are using this APM as well. There are companies, they are using this APM as well. See, I've recently seen reports that some companies are considering reporting their 2020 profits before the effect of COVID-19. Not difficult, it's easy, you guys know now. The suggestion is that it would be beneficial to adapt earnings before interest, tax, depreciation, and amortization, so that it become earning before tax, depreciation, amortization, and COVID-19. Let's consider whether this EBITDA would be a useful measure for users or not. Wait. Because of the COVID-19, most business will have incurred additional cost, impairment losses. Yes, impairment IS was super hit in impairment in COVID. Provisions for redundancies. Yes, we did. People did redundancies. People did restructuring. Restructuring was a common phenomenon of COVID. Additional cleaning cost to the name, but these could be added back to EBITDA on the basis that they were non-recurring. See, COVID-19 was a one-off event. COVID-19 was a one-off event. So these things must be added back. However, but see this is called U-turn. This is called U-turn. In SBR paper, don't just go in one direction. Always keep a room to come back. In our company, in my country, or in worldwide, in major this subcontinent, politics is very dirty. Many politicians first join the first political party, then after few years they join another political party, then another political party. So those politicians which are very sharp, they do criticize their last parties, but always they keep a room to go back. Always they keep a room to go back and join it again. So I always advise employees, because you guys are going to be employees. So whenever you leave any organization, try to leave on good pace, right? Because sometime you have to go back. So in writing the discussion, keep some room for reversal. See, however, given the likely duration of COVID-19, impact this could be hard to argue. Impact this could be hard. Listen, now COVID-19 is 3 years old. Just think. So, do you think it's a one-off event? Do you think this is a one-off event? So this is also a question. Now the last few words. Some might advocate that EBITDA should also reflect additional hypothetical revenues and profits that would have earned, only those who understand English, they can understand, that would have earned if the COVID-19 had not occurred. There are some people, they say that if there wouldn't be any COVID-19, we will have more revenue. So let's book those imaginary revenues. Let's book that imaginary revenue. I think that's not fair. That's not fair because they are not real revenues. That's against faithful representation. See, that's again faithful representation. Some people say that if there was no COVID-19, if there were no lockdown, we could have earned this much. Let's report those artificial imaginary earning. No, 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 don't do this. Don't do this. Yes, you can do the real bad, you can reverse the bad events, you can remove the impact of bad events, but you cannot artificially create the good events. You cannot artificially create the good events. Be careful. Be careful. Did you understand it? Now read the conclusion. Please write on the chat box, please. I will be happy if you write on the chat box.